Here's the problem with the blind pool. The blind pool is great because it'll allow you to raise money maybe before you have deals under contract. You know what? Instead of attaching property information to your offering documents, you're going to attach your business plan. But the downfall is that it is the hardest possible way to raise money. So when you tell somebody that you have a private equity fund or a blind pool fund, the instant images jump up in their minds of you in a Ferrari with private jets and exotic vacations, and them driving a Toyota, shivering in the winter in their homes. For the ordinary people who are buying, 2-3 deals a year, it's going to be a challenge. But then there's these hybrids that you can think about. So one of them, we call it the deal by deal model. So you're still creating one LLC that's going to raise money from investors, but instead of raising all the money in one pool, you're going to separate it by classes within that LLC. My experience with those, I call them quasi-institutional investors, is that they don't want to go into a blind pool fund. They might like your deal and they will co-invest alongside your fund. But your fund is really better reserved for your, what they're called retail investors. So the red flags here are that these capital raisers. Okay, so you get people who will say, oh, I can raise capital from my group of investors. So how do you get compensated? Well, the way to legally get compensated in that scenario where you're bringing your investors to somebody else's deal is that you become a part of the management team. You really have to be very cautious if you are a syndicator about who you let in and what role they play and making sure that they actually perform that role. The regulators don't want to see transaction-based compensation, and they interpret that very broadly. You in a Ferrari with private jets.